I'm Al Brooks, and this is my price action trading course. The current module has to do with pullbacks and bar counting. A pullback is simply a pause in a trend. The trend usually resumes, and the pullback provides a high probability, low risk entry. Bar counting is one method that I use to help find pullbacks. In a strong trend, a pullback oftentimes just goes against the bull for a bar or two. It might be a small inside bar. It may be a bear bar. It may drop 2 or 3 bars. But usually in a strong bull trend, the first pullback only has one leg down before the bull trend resumes. In a weak trend, for example in a channel, traders often wait for bigger pullbacks, like pullbacks that have 2 or 3 legs down. Rarely a pullback will have even 4 legs down. An example of a 2-legged pullback is an ABC correction. A triangle is an example of a 3-legged pullback. A wedge bull flag is another example of a 3-legged pullback in a bull trend. When does the pullback end? As soon as the current bar's high extends at least 1 tick above the high of the prior bar, that is the end of the current leg down. If it's a total of a 1-legged pullback and the trend resumes, as soon as that current bar goes above the high of the prior bar, the pullback has ended and the trend is resuming. With bar counting, I'm counting the number of attempts that the trend makes to resume, and it's the same as the number of legs in a pullback. For example, in a 2-legged pullback, an ABC correction, after the first leg down, the market tries to turn up. That's a high 1. The market turns down again for a second leg, and when it tries to resume up again that second time, that is a high 2 buy setup. In a sideways to down market in either a bull trend or a trading range, either a bull trend or a trading range, not a bear trend. If the high of the current bar, if the high of the next bar goes above the high of the current bar becomes a high 1 buy signal bar. You can call it a high 1 buy setup or a high 1 reversal. The bar that goes above the high is the high 1 entry bar. That would be the bar in which you enter the trade. You'd place a buy stop 1 tick above the high of the signal bar. The high 1 ends the first leg of the sideways to down move, and it might be the end of the pullback in a strong bull trend. It may be the first leg down in a larger pullback, for example in a triangle or a wedge bull flag. If the market continues sideways to down after the high 1 triggers, the next occurrence of a bar going above the high of the prior bar is a high 2 reversal, and that ends the second leg of the correction. There are lots of ways to do the counting, but you shouldn't lose sight of the goal. The goal is to look for pullbacks to buy in a strong bull trend. For example, a pretty good bull spike, a 1 bar pullback, so it's a potential high 1 buy signal bar. Traders might want to buy 1 tick above the high of that bar. Here, the market turned down again for a second leg, so you can call it an ABC correction, A, B, and C. If the market goes above the high of this bar, that would be going above the high of the second leg down. This would be a high 2 buy signal bar, and it would be a reasonable setup for a long in a bull trend, buying 1 tick above the high of the bar. Here we sold off after 7 or 8 bars up, and the first time the market goes above the high of the prior bar is a high 1 entry. So this bar, this bull bar, is a high 1 entry, and this is the high 1 buy signal bar. So as the market's selling off, traders will place a buy stop to go long 1 tick above this bar, and then 1 tick above this bar, and then they get filled on this bar. Here you could call this a high 2 buy setup because it's part of a larger correction. 1 leg down here, the market went up, and then a second leg down here. Anytime you see a double bottom, you have 2 legs down, and that means it's a high 2 buy setup. You could also call this a smaller high 2 because the market went up to this bar, went down for a small bar, and then up again, and then down again as well. So it's a high 2 with respect to this high 1, and it's a high 2 with respect to this larger pattern, this larger high 1. Another bull spike, a pause, a 2-bar pause. So it's a high 1 buy setup, and here's the high 1 entry bar. 1 tick above the high of the prior bar is where you get long. It went sideways more, so here we have a sideways correction, a down bar, a couple bars up, another down bar. So that's 2 legs sideways to down. So this inside bar is a potential high 2 buy setup, and traders will place a buy stop 1 tick above its high to go long. Another bear micro channel and a strong bull trend, and it's a high 1 buy setup. You could also call this a high 2. We have a bar down here, and then a bull bar, an up bar, and then down here. It doesn't really matter what you call it, as long as you remember the goal. The goal is to find setups that will allow you to enter in the bull trend. Here you might want to wait until we get closer to the moving average, and to see if we get a better signal bar. And here, that's what we have. We have a bull body, which is a better signal bar, so a high 2. You can count it using the pink numbers, high 1, high 2. We went sideways here and had 3 pushes down. A bear bar, up, a couple more bear bars, up, a couple more bear bars. So 3 pushes down. In my mind, I think of any 3-push pattern that's basically horizontal as a triangle, even if it does not have a triangle shape. So the buy setup is above the high of this bear bar. We have a 2-bar reversal here, so you could go long 1 tick above the high of the bull bar. If the trend continues down, the 3rd leg ends with a high 3 reversal, and the 4th leg ends with a high 4 reversal. There are no high 5s. If the market goes beyond a 4-legged pullback, you're probably in a bear trend, and I think you have to give up looking for a trend resumption. What about sideways to up in a bear trend or a trading range? Not in a bull trend, in a bear trend or a trading range. If the low of the next bar goes below the low of the current bar becomes a low 1 sell signal bar. You can call it a low 1 sell setup or a low 1 reversal. If the bar goes below the low of that signal bar, the current bar then is the low 1 entry bar. This ends the first leg up in the sideways to up move, and further legs are setups for low 3 shorts, low 4 shorts. Again, there are many variations on how to count and many acceptable ways to do the labeling. You can't lose sight of the goal. You're trying to find low risk entries in trends or in trading ranges as well. Again, don't lose sight of the goal. You're looking to buy pullbacks in a bull trend. When you're looking to buy a high 2, you're simply looking to buy a 2-legged pullback, an ABC correction in the bull trend. Wedges are 3-legged moves. They're basically triangles that are angled up or down. Anytime you see a 3-push pattern, here we get 3 pushes up, bar 1, bar 2, bar 3. You always got to think about the possibility that it will function as a wedge even if it does not have a wedge shape. So this is a low 3 sell setup. Here's the low 1. Okay, first push up, we went below the low of the prior bar. Second push up, we went below the low of the prior bar, so a low 2. And a third push up, the entry is 1 tick below the low of the signal bar, so traders would go short on this bar. When we traded down, basically a trading range, remember. So you can short a low 3 at the top of a trading range. You can buy a high 3 at the bottom of a trading range. We had a leg down. The market went above the high of the bar, so that's the high 1. A second leg down. The market went above bar 2 over here, so that's a high 2. And then we had a third leg down, and when the market went above the high of this bar, it formed a high 3. The third leg down subdivided into even a smaller wedge. 1 push down here, second push down here, ending with a bull bar and then a third push down. So there's a nested pattern. There's a wedge inside of a larger wedge. Double tops and bottoms. All double tops are low 2 cell setups. Anytime you see a double top, just think of it as a low 2 cell setup. Anytime you see a double bottom, think about it as a high 2 buy setup. And don't enter unless the context makes sense. If you're in the middle of a tight trading range, you're going to see lots of high 2s and low 2s, and you should not be taking the entries. The context has to make sense. All double tops are low 2 cell setups. For example, the market went up here and went down. It tried to reverse up here, and instead it double topped and turned down. So there's a 2-bar reversal up and down, and it's a sell signal below the low of that bar for the low 2 short. You could short below the bull bar, but in general I prefer to short below bear bars. Market went sideways up a little bit, so there's a third push up here, bull bar, up here, another bull bar, up here, third bull bar, so 3 pushes up. That's also a triangle, and here there's a bear inside bar for the signal bar. So you can call it a low 2 short below bar 2, or you can call it a triangle below bar 3. Here is a double bottom. The market had a strong bull spike, 6 consecutive bull bars, a good sized bull bar, a weaker sell-off, overlap, bull bar, sideways in here, and we have a low and a double bottom. So double bottom is a high 2. This is either a trading range, it is a trading range for sure, but it could also be the start of a bull channel. So you're looking for high 2 buy setups in trading ranges or bull trends, and that's what this is. This is either going to be a bull trend or a trading range, so buying a high 2 makes sense. And there are other ways to count. So instead of calling this bar 1, you could call this bar 1. The market tried to resume up here and then had a 2-legged pullback here. So it doesn't matter if you call the high 2 these 2 bars or this bar and that bar for the double bottom. Over here I mentioned earlier that we have a double top, so a low 2, and then we had a third push up, and that makes this a low 3 cell setup in a bear trend. And what about high 4 and low 4 setups? When a pullback lasts so long that you're wondering if the pullback has turned into a trend in the opposite direction, after a high 3, for example, start looking for a high 4. Same thing in a bear trend. If the pullback goes on for a long time, start counting to see if there's a low 4 sell setup, because a lot of times you'll get a good resumption of the trend from a low 4. Many pullbacks are in channels, and the channels often end with 4 legs. For example, a pullback in a bull trend oftentimes goes down 4 legs, forming a high 4 and then a rally. A pullback in a bear trend oftentimes goes up 4 legs, and that is a low 4 sell setup for resumption of the bear. A lot of times a high 4 is just a pair of back-to-back high 2 setups. So you get 2 legs down, high 2, and then a rally, and then another breakout and another 2 legs down. And a low 4 in a bear trend is often a pair of consecutive low 2 patterns. So you go up once in a bear, and then twice, and then you start to resume, and then you get a bear breakout, and then another 2 legs up, and that's a low 4 sell setup. Here are examples. On the left, we have a strong rally, so traders are looking to buy pullbacks. They could buy the high 2, that's reasonable, but instead of the market resuming upward, we got a downside bear breakout for 2 more legs. So now we have 4 pushes down. We have a bear bar here for 1 push. We have a second push down here, a third push here with these 3 bear bars, and then a 4th push down with these 3 bear bars. So you can call it a high 2 and then a breakout and another high 2, or you could simply count it as a high 4, high 1, high 2, high 3, high 4. And you always have to be thinking about high fours when you have a channel correcting in a bull trend. As long as the market's staying above the bottom of the bull spike, it's still always in long, unless we get some strong sell setup in here, which we do not have. So it's still a bull trend, so you're looking to buy pullbacks. And don't give up after the high 3. It's not a very good looking signal bar for the high 3 anyway. Don't give up after the high 3. As soon as you see the fourth push down, you place a buy stop one tick above its high, just in case you get something like this. In a bear trend, same thing. We have a trend down, and we have a pullback to the moving average, an attempt to resume, a low 1, another pullback. So now we have an ABC, 2 pushes up, A, B, C, so a low 2 sell setup, and the breakout attempt with this bear bar immediately reversed back up, and we have a third attempt, and now we have a fourth attempt. You can short either below that bull bar or below the low of this bear bar if you want to treat it like a 2-bar reversal for a low 4 sell setup. So it's back-to-back low 2s. There's a low 1, low 2, and then a second low 1, low 2, or you can simply call it a low 4 sell setup. This is the same chart, but a 15-minute chart, and that low 2 that we just saw on the 5-minute chart actually is just a simple low 2 on the 15-minute chart. Once you have a breakout and the trend resumes, you start the process over. You're looking to buy or sell, depending bull or bear trend. You're looking to enter on the next pullback. So with each breakout, you start looking for another pullback, and you start the count all over again. If a pullback keeps growing, like if you have a bull trend and you have a pullback and you have a high 4 that forms and the market just keeps trending down, the pullback can become a trend in the opposite direction. For example, here's Treasury bond futures, a huge bull spike, huge follow through, so traders are looking to buy a pullback. Pretty climactic, might be an exhausting gap. We got one push down, a second push down, and a third push down to the moving average, and it's a very nice looking wedge bull flag. Traders could buy above the high of this bar, or they could take a second entry, which is buying on a stop above the high of that bar. It's also a moving average gap bar. The high of the bar is below the moving average, and that's usually a fairly reliable buy signal for a pullback in a strong bull trend. But look what happened. The buy stop above the high of this bar never got hit, so the bulls never went long. Instead, the market started to sell off more. Here we have a bull II. We have an inside bar and a second inside bar, and it's a bull body. You can count it as 3 pushes down. 1, 2, 3. So we had the breakout here with 3 pushes down. 1, 2, 3. So you can try to convince yourself that it's a small wedge. But when the channel down is this steep, I would not buy until after the market had a strong bull breakout and then a pullback. So I would not buy above the bull II. And this is what happened. That bull II became a low 2 bear flag. Push up here, so low 1, and second push up here, low 2. So you would short below the low of that bar, test of the moving average, double top with this bar. So you can call it a double top, you can call it a triangle, you can call it low 2, doesn't matter. Here's a push up here, second push up here, second push, third push here, so a triangle. Doesn't matter. You'd short with on a stop 1 tick below the low of that bar, and your initial protective stop is 1 tick above the high of the bar. And your initial target, you might want to go for 1 time the risk. The risk is so tiny, I would not go for that. You might want to go for 2 times the risk. I wouldn't go for that. The risk is so tiny, I would wait to see what the breakout looks like. We have a good breakout bar here, second breakout bar here, third breakout bar here. It looks like the market is capitulating and deciding that it's no longer a bull trend. So with these 3 bars, I think traders stopped looking to buy a pullback and instead became convinced that the market's always in short. So now they're looking to sell rallies. For example, here's a pullback, 1 bar up after the 3 bar bear spike, traders would short that as a low 1. Second push up, double top, the high of this bar, the high of that bar. Double tops are rarely exact, but 2 pushes up create a double top, a low 2 sell setup. A pause bar here, you can argue this is a small triangle, a triangle sell setup. The height of the spike, let's say you sold this close. Your stop is going to be 1 tick above the high of the spike. So up here at this gray line, that's your initial protective stop. Your initial target, you might want to go for 1 time the risk, which would be here, thinking that it's now a clear bear trend, so that means 60% probability. 60% probability, you can go for a target that's just equal to your risk. If you want, you can try to go for a target that's twice your risk. You can sell closes, you can sell the low 1, you can sell the low 2, you can sell the triangle. It doesn't matter. Your initial protective stop is up here. Again, if the move goes down too far, you start the count over again. You can call this a low 1 because of this pullback. You could also call it a low 2. The market went up here, down, and up a second time. The market traded down again, broke to the downside again. So at this point, I would start the count over again. We have 2 bars up, so this is potentially a low 1. A second bar up over here, potentially a low 2. You could call it a low 1 as well. No pullback. The market did not trade below the low of the prior bar, so you could say it's a small bull micro channel and therefore a low 1. Doesn't matter. You're just simply looking to sell a pullback, and here we have a pullback to the moving average. And on a smaller time frame, you can see that it's subdivided into a low 2. Push up and down with this tail, and then up again. So bear trend. A pause at the moving average, low 1 or low 2, a reasonable short. In a strong bull trend up here, you only want to look to buy. Remember, a low 1 and a low 2 is for shorting in a trading range or in a bear trend, not in a bull trend. So you can look at this and say, well, we're in a trading range all through here, and therefore we should short a low 1 or a low 2. Except that we're no longer in a trading range here. When you start to see a strong bull spike like this, the market's breaking out, and at this point it's a strong bull trend. So in a strong bull trend, you don't think about shorting, so you don't think about low 1s and low 2s. So you do not take shorts here. You should also be thinking about higher time frames. Sometimes the market can be in a trading range on the 5-minute chart, lasting for hours, but it may simply be forming a high 2 buy setup on the 60-minute chart. And if you're aware of that, you can spot an early entry on the 5-minute chart, an entry earlier than what you would take on the 60-minute chart. For example, here's the 5-minute chart, a big sell-off, and then a rally, and then another big sell-off. Okay, double bottom is always a high 2. And you can say, well, Al, I don't want to buy this. Well, you can also view it as a triangle, 3 pushes down, 1, 2, 3. You can view it as a breakout pullback buy. We have the high 2 buy here, and then the market continued breaking out to the upside, pulled back, and had a bull reversal bar. Bottom line, it's basically a large 2-legged correction. A sell-off here, the market attempted to resume through here, and then sold off again. So this is a large high 2 buy setup. And on the 60-minute chart on the left, that's what it was. This whole thing that we see right here on the 60-minute chart is just these 5 bars pulling back. We had a push below the low of the prior bar, 1 leg down. The market tried to resume. And then we had a second attempt down. And on the 60-minute chart, we have a bull signal bar. We have a gap up and 4 bars up, so a pretty strong bull trend. So traders will buy high 2s. They'll look to buy above the high of this bull bar on a stop, 1 tick above. You can enter earlier on the 5-minute chart, either above this bear bar, which I would not, but above this bull bar, I think it's a reasonable buy. And this is what followed. The market went up to the upside pretty strongly. On the right, you can see the 5-minute chart, and on the left, you can see the 60-minute rally that followed the high 2 buy setup. You also have to be thinking about lower time frames. Sometimes the market will be forming a high 1 on a 5-minute chart, but it might be forming a high 2 on a 1-minute chart. So you can infer what's going on a lower time frame chart or what's going on a 5-minute chart. So for example, we have a gap up and then 2 very strong bull bars, and we're starting to correct sideways. The market did not get above the high of this bar. It finally got above the high of this bar. You can call this a high 1 buy setup, the first time the market went above the high of the prior bar. But you can also say, wait a minute, it went down on this bar and then up here and then down again, another bear bar. So you know that on a smaller time frame there was a high 2 buy setup. There were 2 legs down, down, up, down. You don't even have to look at the 1-minute chart to see that this is a smaller time frame high 2 buy. Here's the 1-minute chart. It's a very strong bull spike. 1 push down, tried to resume, 2nd push down, double bottom, high 2 buy setup. I would not bother looking at the 1-minute chart. You can infer it based on the 5-minute chart. High 1 or high 2, it doesn't matter what you call it. You just have to understand what's going on. You're looking for small pullbacks to buy in a bull trend or in a trading range. Okay, again, this is what I was saying about this 5-minute chart. You can call this a high 1 because the market never triggered a prior high 1. It did not get above the high of this bar. So this is the first time the bull is resuming, so you can call it a high 1. Or, like I said, you can infer that, hey, wait a minute, there were 2 pushes down here. It went down, up, and down, so you can call it a high 2. Again, it doesn't matter. You just have to look at this and say it's a strong bull trend, and therefore you want to buy above the high of the prior bar to catch the resumption of the trend with small risk. So you buy above up here, and your stop is here, so you have small risk and probability. And why does a high 2 work and why does a low 2 work? Because when trading a counter trend, most traders will let the market go against them once, but they'll not let it go against them a second time. Okay, how does that translate into what's going on with a high 1 or a high 2? Okay, and a bull trend, okay, if you're getting a pullback, a high 2 pullback is a second attempt to resume the bull trend. And if you're short, most bears will get out. The market made 2 attempts to go down, 1 and 2, and if it now goes up, the bears will give up. So the bears will get out when the high 2 triggers. And bulls, if they're flat, they'll buy at the same price. So you have the bulls buying to get long, and you have the bears buying to get out of shorts. So there's nobody left to sell, and that makes high 2s reliable buy signals in bull trends. Okay, both the bulls and the bears are buying. There's no one left to sell at that price, so the market has to go higher to find sellers. In a bear, a low 2 is a second attempt to resume the bear trend. If a trader is long and the market, if the person's bottom picking and they're long and the market goes up and then triggers a low 1, they might hold long. If it goes up again a second time and turns down a second time, triggering a low 2, most of those early bulls will exit. They would have given the market 2 different chances to go up, and if it failed both times, they would be concerned that the bear would be resuming, and they would exit when the low 2 triggered. Bears who are flat, they'll enter on the low 2 looking for a resumption of the trend. Okay, so you have both the bulls and the bears selling, no one willing to buy, so the market has to go down, and that makes a low 2 a reliable sell signal in a bear, because the bulls are selling out of their longs and taking their losses, and the bears are selling to capture the resumption of the trend. So for example, in a bear trend, big gap down, market selling off, the bulls might buy above this bull bar. And then they may hold with the stop below the low of the bar, and they'll allow the market to go against them one time. It did right here. And now the trend is resuming again, and they're getting pretty excited. They had 3 bull bars here, strong bull bar here, 3 bull bars here. So the bulls are getting pretty excited that they may be capturing the low of the day. However, this next bar, a bear bar closing on its low, the bulls won't hold any longer. They'll look at this and say, well, it tried to go up here, failed. Tried to go up here again, it looks like it's failing if it gets below the low of this bar. so the bulls will get out below the low of this bar. Bears will short here for a scalp, betting that it's a reliable, high probability sell setup, and there was enough room down here for a scalp. And that is the end of this module on pullbacks and bar counting. Thank you.